Hello traders. In this lesson we will talk about lagging indicators. As the name implies, these are indicators that are late in comparison to the price. These indicators do not provide forecast of future price movement, but are used, for example, to confirm a trend, so they can tell us whether to stay in an open position or to close it and so on. The first and basic lag indicator is the moving average. Moving average represents the average of a price over a period of time. For example, if we take into account, let's first select the indicator. If I enter 10 in the period field, what does that mean? This means that the indicator will take the last 10 candlesticks into the calculation. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So these 10 candlesticks will be taken into account by the indicator. It will calculate the average value of these 10 candlesticks and mark it as 1 point. Then when a new candlestick appears, it will again take last 10 candlestick, calculate the average value and mark it as 1 point, and so on. When a new candlestick appears, it will take the last 10 intraday count, calculate its average value and mark it as a single point. When all these points are connected, we get a line of moving average. When I press the OK button, the moving average line appears. This line is created by connecting dots. That represents the average value of the last 10 candlesticks. If I enter 100 in the periods field, the indicator will take into account the values of the last 100 candles and calculate its average value. If I enter 200, the indicator will take into account the last 200 candles. As you can see, in the first example, when we use 10 candles, we have a much more sensitive, or better say, more dynamic line than this moving average 100, which has a much smoother line. This is because it represents the average value for a much longer period than this moving average 10. I will delete both of these indicators. Okay, how can you use this indicator in trading? There are several ways. First, let's say that a D1 chart is used to determine the main long-term trend, and traders use the simple moving average 200 to confirm the main long-term trend. In addition to the simple moving average, we also have exponential smooth and linear weighted MA. Traders generally use simple and exponential moving average. What is the difference between the simple and the exponential moving average? I will include the other one. Okay, it's a slightly different line. The difference occurs because the exponential moving average gives more importance to the last candles. For example, if it takes 200 candles for calculation, the last candles, that is the new ones that appear, we have more weight, which is not the case with a simple moving average. Now that's the only difference between these two moving averages. As you can see, the lines are similar and there is no drastic difference between the two moving averages. Okay, I'll delete both and turn on simple moving average 200 again. This moving average tells us the long-term trend, direction for a particular currency pair, but it can also be used as a support or resistance level. Look at the situation, the price is falling right from the moving average line. Then we see a deduction again from the same line. And here we have the same situation for the third time. The price bounced exactly from the moving average and continues to fall. But does the rule say, as long as the price is below the simple moving average 200 on a daily time frame, traders can believe that the downtrend is still strong when the price breaks that level. And when the price is above the moving average, we have confirmation that there has been a change and we can expect a growing trend in the upcoming period. Well, that's a general rule for the long-term trend. But of course, you don't have to use just this moving average. There are many currency pairs to trade. On some currency pair, better results give moving average, 200 on, another 100 on, trend 50, and so on. So you should try MAR with different periods. So instead of moving average 200, I will now activate moving average 100 to see if we have any better results. Honestly, we don't. Let's try with exponential moving average. Now, we have a slightly better picture. Please pay attention on how many times the price declined from the exponential moving average. 100, 1, 2, 3, 4, 5 times, as you can see. The price has almost always broken this moving average. But these are just candlestick shadows. I'll give you a tip instead, candlestick chart. Switch on the line chart, Alt and number 3. Look, now when I change to the line chart, we see that the price declined exactly from the exponential moving average, 100. Right from that line, the price started to fall. Here is the second time, then the third time, the fourth time, and the fifth time. We can conclude that the price on this currency pair respect the exponential moving average, 100. So we should use this moving average on this currency pair, of course, or any other currency pair is required to do the same. Try different moving averages to see which gives the best results. The simplest rule in trading with moving averages is to open a buy position. When the price breaks the moving average from down to up, vice versa. When the price breaks the moving average from up to down, then you should open the sell position. However, I consider it a pure gambling. Traders also often use a combination of moving averages. This is done by adding beside moving average with more periods like this one of 100. Second one, which is more sensitive, and this is a moving average with fewer periods. So now we will include another moving average, which is an exponential moving average of 10 periods. I will change color and press OK. What are traders doing now? They are no longer paying attention to price and moving average intersections, but they are waiting for breakouts of this blue line or sensitive line through the moving average 100. These sections are taken as signals to enter a buy or sell position. Well, that would be it for the moving average. In the next lesson, I will talk about the Bollinger Bands indicator. It's also a lagging indicator because it's based on moving averages. See you next time.